Get the latest on what's going on this earnings season, meets, beats, and more in Zach's Earnings Scorecard.
Hi, Shiraz Mian here to give you an update on the Q4 earnings season. Our primary index for discussing earnings will be the S&P 500, but we will provide plenty of details about the small cap Russell index as well. And towards the end, I want to share with you a visual image of how estimates for the current and following quarters are shaping up. It's a pretty interesting picture for the 2015 Q1 and Q2 earnings seasons. So let's dive right into it. The earnings season is about 80% over for the large cap S&P 500 index. We are about halfway through for the small caps. The overall picture emerging from the results thus far is on the weak side for the S&P 500 and somewhat encouraging for the small caps. Here you have the big picture scorecard for the S&P 500. As you could see, as of this morning, which is February 18, 82.1% of the index members have reported results. That's 412 S&P 500 companies. 6.5% total earnings growth, 1.2% total revenue growth, 69.2% beating earnings, and 56.3% beating revenues. Take a look at the column, the row, indicating the energy sector, 17.4% earnings decline. Another thing to keep an eye on is this column, the price impact column. In specific, I want you to keep an eye on this 3.35% growth, price impact growth showing for the retail sector. And as you could see, we are just about halfway through for the retail sector. The retail sector stock prices have been responding the best of any other sector. The primary reason, in my judgment, for that is, even though the retail results thus far don't show any particular improvement from what we have been seeing from the sector in the recent past, that folks are looking for an opportunity of where the dollars saved from the oil decline, from the gasoline decline, and from the resulting improved household buying powers will show up. And that's the primary reason for why we are seeing this optimistic and favorable reaction to how the market is responding to the retail sector. Here, what we are doing is comparing the results thus far with what we had seen from the same group of companies in other recent quarters. So the 6.5% total earnings growth compares to 6.9% earnings growth from the same group of companies in Q3, and the four-quarter average of 7.1%. On the right side is a similar comparison for beat ratios. The orange bars represent earnings, the green bars represent revenues. As you could see, the earnings growth rates and the earnings and revenue beat ratios are about in line with historical levels, but the revenue growth rate is decidedly on the weak side. So in the large cap S&P 500 snapshot, as you saw, the growth picture isn't materially different from what we had been seeing in the past, but top lines are weak. Let's see how the picture for the small cap universe is. And here we have a comparable scorecard for the Russell 2000 index. As mentioned earlier, 46.7% of the Russell 2000 index members have reported results. Here is the 20.5% total earnings growth. There's 9.8% total revenue growth, 49.2% beating earnings, 36.5% beating revenues. And these lower beat ratios are not unusual for the small caps. In fact, about 50% would typically beat earnings, about 40% would beat revenues, which is completely different from what we typically see for the large caps. For the S&P 500, as you know, roughly 2/3 beat earnings and about 50% beat revenues. My reasoning for this variance between the small and large cap is the limited coverage that the small cap companies have relative to the S&P 500. So how do the small cap results compare to what we have been seeing in the past? And that's what we show here. As you could see, the top left column, the 20.5% earnings growth, is materially better than what we had seen from the same group of Russell 2000 companies in Q3 as well as in the 4-quarter average. The beat ratios are a tad bit on the weak side, but not materially so. So overall, stronger results in terms of growth rates, at least, from the small cap stocks. And my thesis for this divergence between the large cap and the small cap is that the issues that were dominantly in play for the S&P 500, namely the strong dollar, the global growth issues, as well as the oil weakness, those are present in the Russell 2000 as well, but not to the same extent. And that seems to be the explanation coming through here. One other piece of tidbit to keep in mind while evaluating the small cap versus the large cap is that the small cap is fairly small in relation to the S&P 500. The total earnings from the Russell 2000 in Q4 14, the earnings season we've been discussing, would be about 7% of the total earnings that the S&P 500 companies will report. In fact, the entire Russell 2000 will report earnings that are just a little bit more than what Apple alone reported on its own. So there is a big size divergence. It is a more of a domestically oriented picture, and that's what we see in the results thus far too. As promised earlier, I want to share with you a picture of how the Q1 15 and Q2 15 earnings revision picture is unfolding, and that's exactly what we show in this chart. In this one, the one on the left side, the green bars represent estimates for the first quarter of 2015, the current period. The orange bar represents the second quarter of 2015. And we track the evolution of these estimates over time. So as you could see, in early October, growth for the first quarter of 2015 was expected to be 10.8%, 7.4% for Q2. And as you can see today, which means February 18, the Q1 estimate has dropped to a decline of 3.5%, a decline of 3.3% for Q2. Effectively, all the growth that was expected in the first half of 2015 has evaporated. The chart on the right side spotlights what's happening with Q1 and focuses on the impact of oil. So as you could see, the gray bar on the right is the Q1 estimates excluding oil. So on an ex-oil basis, earnings are still expected to be up 4.4%, but that's a sharp drop from what was expected earlier, just a few months back. And that's the overall takeaway from this earnings season. What we saw as the Q4 earnings season unfolded was that estimates for the quarter started coming down at a pace that we haven't seen at all in the recent past. Of course, energy was a big reason for the decline, but the growth and the earnings picture beyond energy isn't that impressive either. And that's the key element that we have to keep mindful of and remain focused on in the coming days whether the growth estimates that have gone away for 2015, will there be any improvement in that going forward or not? With that, I'll leave you till next time.